Good afternoon, everyone. Thank you very much to the Shanghai Platinum Week Organisation Committee for inviting me to speak. Thank you to our wonderful translators who have been working all day. And I apologise to them, you have to deal with my accent so late in the day. I'm going to keep it quite high level. I mean, we've heard a lot about supply and demand, particularly in the platinum side. I'm going to round up some of the things we've heard and put it in a global context, and particularly around some of the thematics. Because when people invest, they think about individual commodities, certainly, but they also think about it from a more thematic point of view. And something we've been talking about more and more is critical minerals. It's become the buzzword in global commodity markets. And we're going to talk about how the PGMs fit into this. Very quickly on BMO, my name is Colin Hamilton. I do the commodity research for BMO, which is Bank of Montreal, based in London. We are big in metals and mining, that is what we do globally. A number of the things we do there, but one thing I wanted to flag was our Global Metals, Mining and Critical Minerals Conference. It will be in its 34th year next year. We hold it every February, and it really is the go-to event for the global sector. Critical minerals, this is a question I get. What is a critical mineral? And as they say, it's in the eye of the beholder. There is no standard definition. It varies by geography, it varies by what people want it to be. But typically, it's something that's important to economic growth, but where there is a vulnerability in that supply chain. I think we've seen it come to the fore more frequently now when we're talking about the global fuel to materials transition and the supply chains that are actually going to be stretched by something that is growing at a fast pace. But when we think of it more by the more standard definition, if you've got dominant suppliers that would qualify, and I'm thinking of that in the context of PGMs, and having a limited number of other supply options, again, similar. These policies are not new, but they are getting a lot more attention now, and we're starting to see a whole number of different policy responses, which I'll talk about. We've also seen a lot more investor interest come in to metals and mining as a sector, both from an institutional investor point of view, but also from governments. I've never seen governments as interested in metals and mining as they are at the present time. So we'll talk about some of the policies we're seeing there. And of course, this does get into geopolitics. And there's, as I mentioned before, they're not new. If you read from the right there to the left, that's the European Union critical minerals list. 2011, there's a few elements on there. If you get now to the more recent one, in 2023, there's a lot of elements. They have been expanding as more and more materials have been deemed critical to growth. And again, I think the vulnerabilities in global supply chains have become a little bit more obvious. One interesting thing to notice there, the PGMs have consistently been on there. They were almost the original critical mineral and certainly need a lot of definitions. Because if you think about it, we're in a world of trade. Commodities are all about trade. Where do you produce something? Where do you consume it? And meet the two there. It's just interesting to look at that right-hand side there. In terms of light vehicle sales, and we've heard many times today, Europe, US, China, the three dominant markets. And if we look at where platinum production comes from, South Africa is of course very dominant in that regard. So you have a natural mismatch between where something is produced, where something is consumed, and that naturally makes it critical. On the individual policies, European Union, what is the European Union stance on critical minerals? Essentially, we have no money to put to work, but let's get everyone together, we'll have a club, and we'll try and get alternative sources to try and alleviate some of our supply chain pressures. You can see there Europe has a high import reliance on a number of commodities. Platinum and palladium are currently above that 90% threshold, which is where the European Union wants to be below by 2030. In terms of it, Europe will struggle to meet some of these targets, particularly given that politics in the region is becoming a little bit more strained. Then there's the US approach, the Inflation Reduction Act. And the US model is very much that if we want something, the market will provide. And arguably in some of these critical minerals, some of the ones on that list, that has been the case. Going back to the BMO Global Metals Mining Critical Minerals Conference, a year ago we had a lot of automakers in the room nervous about security of supply. Come this year, it was undeniably less because they would come and they would say, well actually, what do I buy? I want lithium, nickel, cobalt for batteries. There's plenty of all of that. I want copper. Actually, we think we're okay for the copper side. So actually, the market has provided, and that's driven this philosophy that actually we don't need to invest in mining. The extraction portion of the funds spent under the Inflation Reduction Act has only been 3% of the total. That compares to actually 170% in what we term the midstream. So you can see there that actually we're not seeing much efforts made still on the extractive side, and that feeds through to the PGMs as well. Then we talked a lot about South African production. I'm not going to dwell on this, but I also wanted to flag that that right-hand chart looks at the Fraser Institute investment attractiveness. And I put up there South Africa and Zimbabwe, very important for PGM supply, and that's the percentile if you want. The lower you are there, the worse that is. And you can see that over time, as jurisdictions, South Africa and Zimbabwe have been falling in attractiveness. And again, this is something that risk departments, banks and trading houses will look at when they're looking to lend into asset development or even sustaining capital for existing assets. And you can see there that is not painting a healthy picture for reinvestment in this sector. I've talked about the cost curves as well. I mean, you can see there, it's not unusual in commodity markets to see prices trading into cost curves, but to trade at a level of a very flat cost curve that we have for the PGMs, where you have a lot of potential supply underwater for a significant period of time. So a great chart from Henk earlier on that. Well, that is quite unusual. And it points to an industry not making maybe the decisions around supply rationalisation that might be needed for a reset. And again, this comes to part of the challenge. Economics drives everything in the end, and this is a bit of a struggle in this industry. Now, I mentioned before, the global mining is back on the radar again. We are seeing a bit of a lift in global mining expansion capex, but actually that's more or less only in line with cost inflation. We have more data on copper. I'll put up that copper chart on the right-hand side. That's just indexing back to 2010, expansion capex and the escalation in that on a like-for-like basis versus US CPI. You can see there that mining cost inflation, this upstream cost inflation is running a lot harder. So there's two stories. There's one, getting stuff out of the ground. The second one is actually just the cost of getting the existing assets and getting production from there. And I think that that latter one is a little bit underappreciated in global markets. The cost floor for a lot of commodities is significantly higher than we would have thought about before. And now we have seen a relative lack of investment. We're still trading as a global mining industry well below 2012, 2013 levels for capital spending. And if we inflation adjust that, it is significantly below. We're not seeing that capital response. Why? I would say there's a couple of reasons why we haven't seen it. Number one is that mining companies generally it's easier to say no. You know building a mine is hard. You know developing that asset is going to be a little bit challenging. And actually, you know your shareholders want that capital back in their pocket. So it's much harder to just make that case for investment. And then when it comes to platinum group metals, well actually, it's much easier for a company to say, you know what, investors really like copper, I get the copper story, we're going to go through the next decade where global electricity demand is going to be running, we're going to be a more electricity intensive phase of global growth than we have seen in the past. I'm going to put my money into copper. So actually, some of these smaller metals tend to suffer in that regard. Now, we're often, when we talk critical minerals globally, it's often, oh, China dominates everything. That's on the refined metal side in many cases. For China, China needs imports of raw materials in order to fuel that refined metal process. In my view, the investment that's been made by Chinese firms in smelting and processing has been crucial in driving global metals demand, through basically providing some deflationary pressure to the world over the past 2 decades. As we get more geopolitical segmentation, obviously there is a risk there. Now, for China, I've just put up the PGMs there. China's share of actual metal production is actually very low relative to many of the others. But in terms of imports are highly costly. I'm not going to pronounce that right-hand index. It's known as the HH index, but it's the market concentration effectively. And you can see there that palladium is highly concentrated, and platinum as well. There's a lot of commodities on there that are an import risk to a certain extent from China. So while critical minerals might be viewed as a problem in terms of the metal for the developed world in particular, for China, of course, the ore imports and getting the raw material becomes very crucial. I think there's a lot of countries out there talking about doing things and securing critical mineral supply. I think I can only see one doing anything, and that is China. We have seen a lot of investment, that's investment in non-ferrous metal mining and dressing in the Chinese economy. You can see their strongest growth rate we've seen there since 2007, last year. And also, even in terms of outward direct investment, we've seen that trend higher over recent years, and we expect to see it trend significantly higher again this year. That is securing raw material supply overseas. You could say the rest of the world doesn't like it, but the rest of the world is not doing anything about it, and we do need to get more raw material extracted in order to serve the world's needs and get towards net zero. When it comes to PGMs, again, what am I looking for in any commodity market? I'm looking for what is China's call on that market. Does China need more? And you can see there that we have seen a pickup in imports, particularly over the first few months, or the first half we almost have now, of this year. Highly dependent still on South Africa, as it is going to be over future years. But it comes after a decade of almost stagnation in terms of China's platinum imports. If we're starting to see this trend, where there is a stronger China pull on global markets, that is only likely to be a good thing in terms of price. For palladium, maybe a little bit less of a acute risk to the Chinese market there. Yes, you're seeing palladium imports pick up a little bit as well. You can see in the right-hand chart there, clearly that has been Russian material which has been displaced from the rest of the world. It has nowhere else to go, and therefore now makes up the majority share of China's palladium imports, and that is something that we expect to continue over the coming years. Just going to finish with a couple of things to watch for in terms of critical minerals policy generally. I would argue that mining jurisdictions around the world know what they have a lot more than they did in the past. We're in a world where information flow is a lot better. Everyone's much better connected. And also, many of the governments in these jurisdictions are much more educated. So it's interesting, that left-hand graph is from a survey by White Case, the law firm. They surveyed many of the major market participants in metals and mining. What do you think will be the responses of mineral exporters to growing market and geopolitical pressures? And the number one response was adopt requirements for local value add. So essentially, do more in country, try and get more value add. We've already seen, put up on the right-hand side there, an example of a success story that everyone would point to. Indonesia, in the nickel market. Indonesia now mines 60% almost of the world's nickel, and it used to be exported in ore form, and then it was exported in ferronickel form, so slightly higher value add. And now we're seeing investment in that and in stainless steel, and Indonesia will get a battery industry going. So this is the template that I think you'll see a lot of other jurisdictions follow, including sub-Saharan Africa. The question is, in getting the workforce educated, there's a lot of challenges, but I would be expecting to see a lot more emphasis on investing with other emerging markets and raw material extractors in the downstream in order to bring stuff to market. And just lastly, I mean, there'll be a session on this tomorrow, I believe, but recycling. It's been mentioned a couple of times today. Scrap is almost strategically the most important product out there at the moment, across all metals. And it's, why is it? Number one, it's lower carbon. Number two, it is something that the developed world is naturally long of. If you think of the consumption, whether that be in old economy stuff like infrastructure, whether it be in automobiles, the developed world is naturally generating secondary material. And you can see there that's just, I mean, cumulative internal combustion engine vehicle sales over the last few years. And you can see, well, actually, those big jurisdictions, and China's, of course, part of that now, will be generating a lot more secondary material. We're already seeing in markets like aluminium restrictions on exports from developed economies in order to keep that, what was a waste, now as a strategic resource. The same will be true in, I would expect, in China. So again, that secondary material goes a long way to alleviating the pressure from the lack of mine supply that we have definitely seen come through. I think it will be interesting as well to see how developed governments respond, both in terms of policy, given they've missed the boat essentially on building new mines. I would expect to see just rebuild of strategic stockpiles. Now that, of course, is something that China has been doing. I thought it was very interesting the point made by Platinum Investment Council before around that need for strategic reserves. Arguably the PGMs is one where China does need to still need to build a little bit more buffer, but expect to see the rest of the world start to again add to the demand side without necessarily solving the supply side of the equation. And just the last thing I want to point out, particularly when it comes down to recycling and if you want assets in use, what are we doing to our models globally? A lot of discussion, of course, as to what's happening in autos markets, changing all the time. It is very interesting, I would say, when we did our first forecast at BMO for the global electric vehicle market, 6-7 years ago now, there was 5 battery chemistries there. Now I think we have 25. That market is moving in multilateral directions. But it's interesting what we're doing. Just one thing I wanted to flag relative to PGMs. We are replacing battery electric vehicles with extended range electric vehicles. And you can see there on that right-hand side, that offers that cliff, if you want, for demand on the PGM side. We're pushing it out a little bit more, given that many of these extended range electric vehicles make a lot of sense. So overall, I would argue that I say PGMs are almost the original and to a certain extent the ultimate critical mineral. You are going to see a lot more focus on this. Yes, there has been a supply response in some areas, but not necessarily in all areas. And given where we are geopolitically and the segmentation that we're seeing, I do think that critical minerals policies will continue to develop in the future, but we're still under-investing in the supply side of the equation. Thank you very much for your attention and enjoy the rest of the day.